Let's go ahead and run through the solution to the second homework problem from Module 8 on intercompany inventory sales. So question 2, assume that Big owns 80% of Little. Starting in 2018, Little sells goods to Big. Information on those sales is as follows. Okay, so first and foremost, this is an upstream transaction, which means the non-controlling interest will be involved. So there's the information on the sales in each year, the amount of the goods resold in the year of sale, the amount resold the year after that, and the year after that. Required, prepare elimination and equity method entries arising from these transactions for all years, assuming Big uses the full equity method. Also, assuming that Little reports earnings of $100,000 per year, what would be the income to the non-controlling interest each year? Okay, so in 2018, first thing we do is we eliminate sales and cost of goods sold in the amount of the intercompany sales revenue. And again, this entry does not eliminate or defer any income. We're debiting sales and crediting in cost of goods sold for the same amount. Then we step back and say, do we need to defer any of the 2018 gross profit? Again, there was a $10,000 gross profit in our 2018 intercompany sale. 40% of that merchandise was not resold in 2018, which means that 40% of that gross profit was not realized, which means we need to defer $4,000 of gross profit. And again, we do that by debiting cost of goods sold, increasing our cost of goods sold, and crediting inventory. Equity method entries. Again, looking at the elimination entry, we have a debit to cost of goods sold for $4,000. So a debit on the income statement in our elimination entries implies a debit to our income statement in our equity method entries. Since this is an upstream transaction, the parent is going to record their share, 80% of that $4,000 adjustment. Finally, the income to the non-controlling interest, again, 20% of, we start with the reported earnings of $100,000. We look at those elimination entries and see a net debit to cost of goods sold of $4,000. That reduces the income. So 20% of $96,000, $19,200. Okay, 2019. Again, first we eliminate sales and cost of goods sold in the amount of the intercompany sales revenue. Okay, next we need to go ahead and defer any portion of this year's gross profit which is still unrealized. Again, in 2019 there was a $20,000 gross profit. 30% of the merchandise was resold in 2019. That means 30% or $6,000 of that profit was realized. The other 70% or $14,000 has not been realized yet. So we have to defer that by increasing cost of goods sold. That lowers our income, and crediting inventory. And again, what this credit to inventory is doing is basically correcting the inventory value, taking it from the inflated or marked up value that it's residing at on Big's balance sheet and restoring it to its true cost by stripping out that gross profit. Finally, we have to carry forward the unrealized profit from the previous year. Recall that in 2018 we deferred a $4,000 gross profit. We're carrying that forward, and to carry that forward, again, we have to ask ourselves two questions. First, is this an upstream or a downstream transaction? This is an upstream transaction, so the non-controlling interest is going to be involved in this. They're going to get 20% of that $4,000. The other 80% of the $4,000, or $3,200, is going to be an adjustment to the parent's books, or to the parent's ledger accounts. Here's our second question then, is the parent using the full or the partial equity method? In this case, they're using the full equity method, which means we're going to carry that forward by debiting the investment in Little account. Again, so $3,200 debit to the investment in Little, $800 debit to the non-controlling interest. On the credit side, we have to ask ourselves, where is that merchandise now? That merchandise has now been sold, so that inflated inventory value is now residing in cost of goods sold, and so we have to reduce cost of goods sold to correct it to its proper level. Next are equity method entries. Again, basically the parent needs to record, under the full equity method, the parent needs to record their share of these income adjustments from the elimination entries, and I've put them in bold italics there. So the first one, we have a $14,000 debit to cost of goods sold, so $14,000 debit to the income statement. Under the equity method, we'll also debit the income statement, the investment income account, for the parent's share, 80% of that $14,000. And again, credit to the investment a little. Similarly, for the second elimination entry, involves a $4,000 credit to the income statement. So we're going to credit investment income for the parent's share, $3,200 of that $4,000. Finally, the income to the non-controlling interest, the non-controlling shareholders get 20% of the adjusted/realized earnings. So we start with reported earnings of $100,000, and we look at those two elimination entries, or again, there are three elimination entries. The first elimination entry has no effect on income. The second one, we put a debit on the income statement for $14,000, that reduces income. The third, we put a $4,000 credit to cost of goods sold, that increases income by $4,000. So the non-controlling shareholders get 20% of $90,000, or $18,000. Okay, moving on to 2020. Again, first we eliminate sales and cost of goods sold in the amount of the intercompany sales revenue. Second, we have to defer whatever portion of this year's gross profit is unrealized. There was a $25,000 gross profit. 90% of the merchandise was resold, therefore 90% of the profit was realized. The other 10%, or $2,500, is still unrealized. We're going to defer that, as always, by increasing cost of goods sold and reducing inventory. Next, we carry forward the unrealized profit from the previous year. Recall that last year we deferred 70%, or $14,000, of the 2019 gross profit. We carry that forward, again debiting the investment in little and the non-controlling interest for 80% and 20% respectively. And now we have to ask where, again, when we deferred that, we were basically acknowledging that this is an upstream transaction, so on Big's income statement there was this inflated inventory, which we had to reduce by $14,000. In the subsequent year, we ask ourselves, where is that merchandise now? Well, looking at the numbers in bold italics up in the table, of the merchandise that was sold in 2019, again, 30% was resold in 2019, 50% was resold in 2020, 20% is still on the books. So of that $14,000, we have two ways we could do this. First, we could look at that and say 50% plus 20% is 70%. So the portion sold is 50% out of 70%, or 5/7. So we're going to recognize 5/7 of that $14,000 as a reduction in cost of goods sold. Alternatively, we could go back to our original data and say originally there was a $20,000 gross profit, of which 50% is now being realized. So we're going to realize $10,000. Similarly, for the credit to inventory, we could say, look, there's still 20% of that $20,000 gross profit which is still unrealized. That merchandise is still on Big's balance sheet at that inflated value. We have to go ahead and strip out that $4,000 out of that inflated inventory balance. Next, for our equity method entries. Okay, so looking at the three elimination entries, we have the first one having no effect on earnings, the second one a $2,500 debit to cost of goods sold, decreasing earnings, the third one a $10,000 credit to cost of goods sold, increasing earnings. Under the full equity method, the parent will record their share, 80%, since this was upstream, of those income adjustments. So a debit to investment income for $2,000, the parent's share of that $2,500 debit to cost of goods sold. And similarly for the other entry, the parent's share, 80% of that $10,000 credit to cost of goods sold, is a credit to investment income. Finally, the income to the non-controlling interest, their share of the adjusted/realized earnings. Starting with the reported earnings of $100,000, taking away the $2,500 of this year's earnings that was not yet realized,